A suite at the Burj Al Arab in Dubai costs $18,000 a night. There is a butler assigned to every guest. There's a Rolls-Royce waiting at the tarmac. And yet, according to hospitality analysts, that hotel has spent years operating at a loss. That is not a typo. The most expensive hotel experience most people will ever imagine, the building that put an entire city on the map, has struggled for decades to actually turn a profit. So here's the question nobody asks when they walk past a five-star lobby dripping in marble and fresh orchids. How does a business charge more than most people make in a month for a single night and still barely break even? The answer is not what you think. And by the end of this, you will never look at a luxury hotel lobby the same way again. Most people assume the math is simple. Charge a fortune per night, multiply by the number of rooms, subtract the cost of clean towels and omelets, and pocket the rest. That is how a budget motel works. It is almost the opposite of how a luxury hotel works. The higher up the ladder you climb, from a Holiday into a Four Seasons to something like the Burj Al Arab, the worse the actual math tends to get. And the reason for that is buried in a part of the business nobody puts in the brochure. Start with the building itself, because that is where the trap begins. A standard 3-star hotel room costs somewhere around $150,000 to build, once you account for land, construction, plumbing, and furniture. A 5-star luxury room routinely costs over $1 million per key. Some ultra-luxury properties in cities like New York or Dubai have pushed that number past $2 million for a single room. That is not the price of the whole hotel. That is the price of one room before a single guest has ever slept in it. Here is where things get strange. That enormous price tag is not really paying for comfort. It is paying for scarcity. A 5-star hotel cannot simply add more beds to increase revenue the way a budget chain can, because doing so would destroy the exact thing guests are paying for, which is space, privacy, and the feeling that they are not sharing the building with 300 strangers. So luxury hotels intentionally build fewer rooms, with larger square footage, more staff per guest, and more in-use space in lobbies, gardens, and pools that generate zero direct income. A 3-star hotel might operate profitably with 60% of its space dedicated to rentable rooms. A 5-star property often flips that ratio, dedicating the majority of the building to experience rather than beds. That decision alone changes the entire financial model, because now the hotel has to charge dramatically more per room, not because the room is worth that much more to build, but because there are simply fewer rooms to spread the enormous fixed costs across. This is where the real numbers start to matter. Industry data on hotel operations shows that staffing costs at a luxury property can run as high as one full-time employee for every 1 to 1.5 guest rooms. Compare that to a mid-range hotel chain, where the ratio is often closer to 1 employee for every 3 or 4 rooms. A guest at a Ritz-Carlton is not paying for a bed. They are paying for the payroll of a small army: doormen, concierge teams, personal butlers, overnight security, dedicated spa staff, multiple restaurant kitchens that may only serve a handful of tables a night, and management layers that simply do not exist in economy hospitality. And almost nobody realizes the hidden cost sitting underneath all of that. It is not staff. It is not marble. It is depreciation. A luxury hotel brand lives and dies by its physical appearance staying flawless. Guests paying $800 a night are not going to tolerate a worn carpet or a chipped headboard the way a budget traveler might. So luxury properties are contractually required, often by the very brand they operate under, to undergo full renovations every 7 to 10 years. Not a fresh coat of paint, a total gut renovation, sometimes costing tens of millions of dollars for a single property. Owners budget for this the way airlines budget for jet fuel. It is not optional. It is baked into the business from day one. Now here is the problem that almost breaks the entire model. Many people assume the person who owns a luxury hotel and the company whose name is on the building are the same. They almost never are. This is one of the most misunderstood facts in the entire hospitality industry. When you book a room at a Four Seasons or a Ritz-Carlton, you are very rarely paying a company that actually owns the building. In most cases, the real estate is owned by a separate investment group, sometimes a sovereign wealth fund, sometimes a private equity firm, sometimes a wealthy family office. That ownership group pays the hotel brand a management fee, typically between 3 and 5% of total revenue, plus an additional incentive fee based on profit. The brand runs daily operations, sets service standards, and controls the guest experience. But the brand rarely carries the financial risk of the building itself. This single detail explains almost every strange decision you have ever seen a luxury hotel make. The reason a five-star hotel will keep an entire floor empty for renovation during peak season, seemingly turning away guaranteed revenue, is because the ownership group is playing a decades-long game, not a nightly one. The reason a hotel might operate a restaurant that loses money every single year is because that restaurant exists to protect the brand's five-star rating, which in turn protects the value of the real estate asset for the owner. The people losing money on the omelets are not confused. They are protecting something worth far more than omelets. This brings us to the case that hospitality analysts love to cite because it is almost too perfect an example, the Burj Al Arab. When it opened in 1999, the Burj Al Arab was marketed as the world's only seven-star hotel, a rating that does not officially exist in any hospitality grading system. It was built on an artificial island, shaped like a sail, and designed to be the most photographed hotel skyline in the world. It succeeded completely at that goal. It has appeared in more advertisements, more magazine covers, and more tourism campaigns than almost any building on Earth. And that was always the actual point. The Burj Al Arab is owned by Jumeirah Group, which itself is owned by the Investment Corporation of Dubai, a sovereign wealth fund. For years, hospitality analysts have pointed out that the hotel likely does not generate profit from room bookings alone, given its enormous operating costs, staff-to-guest ratios, and constant renovation cycle. But that misses why it was built. The Burj Al Arab was never designed to be a profitable hotel on paper. It was designed to be a marketing engine for an entire country's tourism industry, and by that measure, it has been one of the most successful investments in modern hospitality history. Dubai's tourism numbers exploded in the decades following its construction, and the hotel remains one of the most recognized buildings on the planet, generating brand value that no balance sheet fully captures. This is the hidden reason luxury hotels exist at all. They are frequently not standalone businesses chasing quarterly profit. They are loss-absorbing status symbols attached to something much larger, a real estate portfolio, a national tourism strategy, or a billionaire's personal brand. But not every luxury hotel has a sovereign wealth fund covering the gap. Most do not. And this is where the psychology of the guest becomes just as important as the spreadsheet. Here is something almost no traveler consciously thinks about. The price of a luxury hotel room is not actually set by the cost of running it. It is set by what economists call a Veblen effect, a rare situation where demand for a product increases as the price increases, because the high price itself is the appeal. A room that costs $400 signals comfort. A room that costs $4,000 signals exclusivity. Luxury hotel pricing teams know this, and it changes everything about how they set rates. Dropping the price to fill more rooms can actually damage the brand because it erodes the exact perception the guest is paying to access. This is why you will almost never see a five-star hotel offer a genuine last-minute discount the way a budget chain will. An empty luxury room, sitting there earning $0 for the night, is often considered less damaging to the business than a discounted luxury room, because the discounted room threatens the brand's entire pricing structure for every other guest. This single psychological quirk is the hidden reason why luxury hotels will let rooms sit empty rather than lower prices, something that looks completely irrational until you understand what they are actually protecting. The mistake almost every outside investor makes when they get excited about buying a luxury hotel is assuming that occupancy is the goal. It is not. Revenue per available room, an industry metric known as RevPAR, matters more than how full the hotel actually is. A luxury property running at 50% occupancy with sky-high rates can dramatically outperform a budget hotel running at 95% occupancy with cheap rates. This single metric is why five-star hotels behave so differently from every other tier of the industry, and why their financial strategy looks, on the surface, like bad business. Now widen the lens, because the history here explains a lot about why the model became this complicated in the first place. Before the 1980s, most luxury hotels were owned and operated by the same company. Names like the Waldorf Astoria and the original Ritz in Paris were monuments built by individuals who wanted to create something legendary, often losing money for years in the process. But starting in the 1980s and accelerating through the 1990s, a financial innovation reshaped the entire industry: the separation of hotel ownership from hotel operation. Real estate investors realized they could own the physical building, collect rental-style income, and let a specialized hospitality brand handle staffing, marketing, and guest experience for a management fee. This split allowed capital to flow into hotel real estate from investors who knew nothing about running a hotel, while brands like Marriott, Hilton, and Four Seasons could expand globally without having to personally finance every single building. This shift is the actual reason luxury hotel expansion exploded worldwide over the past 3 decades. It was not because hospitality suddenly became wildly profitable. It was because the financial risk got split into 2 separate businesses, each willing to accept a smaller, more predictable slice of a very large, very expensive pie. But splitting the risk did not eliminate it. It just moved it. This is where the real case study gets uncomfortable, because it involves a name most people recognize: the Plaza Hotel in New York City. Opened in 1907, the Plaza has changed ownership more than half a dozen times, filed for bankruptcy protection in the early 1990s, and been sold to a series of investment groups from around the world, including a period of Indian ownership through the Sahara Group, before eventually landing with Qatari investors. Each new owner inherited the same brutal math: an iconic, universally recognized building that costs enormous sums to maintain, sitting on land so valuable that the real estate alone could be worth more than the hospitality business operating inside it. In 2018, portions of the Plaza's upper floors were converted into private luxury condominiums, some selling for tens of millions of dollars, because condo sales generated more predictable, front-loaded income than another century of nightly room bookings ever could. That decision reveals the biggest problem hanging over the entire luxury hotel industry today. In many of the world's most expensive cities, the land underneath a historic luxury hotel has become more valuable as literally anything else. Office space, luxury condominiums, retail. The hotel business, even at its most expensive nightly rate, often generates a lower return on that land than converting the building into something else entirely. Every historic luxury hotel still operating in a major city center today is, in a very real sense, competing against its own real estate value. This pressure has forced the industry to evolve in a direction few travelers have noticed. Branded residences, private members clubs stacked inside hotel towers, and hybrid ownership models where guests can literally buy a room outright have become the fastest-growing segment of luxury hospitality. Brands like Aman, Six Senses, and even Ritz-Carlton now generate substantial revenue not from nightly guests at all, but from wealthy individuals purchasing branded residences attached to the hotel, paying 7 or 8 figures for the right to live inside a 5-star brand year-round. The nightly guest, the person this entire industry appears to be built around, has quietly become almost a secondary revenue stream behind real estate sales and long-term brand licensing. So where does that leave the future of the industry? Post-pandemic travel data shows something counterintuitive. While budget and mid-range hotels struggled to recover pricing power, ultra-luxury properties recovered fastest and pushed rates higher than ever. Wealthy travelers, sitting on record levels of accumulated savings and starved of experiences during years of lockdown, proved willing to pay historic premiums for space, privacy, and exclusivity. This accelerated a trend already underway before the pandemic: luxury hospitality brands shifting away from simply operating hotels and toward becoming full lifestyle ecosystems, selling everything from private jet partnerships to branded skincare lines to residential real estate, all under the same five-star name. The hotel room itself, the thing that started this entire industry more than a century ago, is increasingly just the entry point. The advertisement, the marble lobby that gets photographed and posted online for free, driving brand awareness that no billboard could ever buy. Which brings us back to the Burj Al Arab and the question sitting underneath everything you just learned. If the most famous luxury hotel on the planet likely doesn't turn a meaningful profit on its rooms, and the world's most historic luxury hotel found more value in selling condos than renting rooms, then what exactly are you paying for when you book a five-star suite? You're not paying for the thread count of the sheets. You're not paying for the size of the bathtub. You are paying to participate for one night in a financial illusion that took decades, billions of dollars, and an entire hidden industry of sovereign wealth funds, real estate investors, and brand psychologists to build. The room was never really the product. The feeling of walking through the lobby was.